Hello, everyone, and thank you very much for joining us today at the Investment and Finance Society's another workshop for the advanced methods for finding the cost of equity. My name is Ben Forgacs, and I'll be covering the kind of overview of what we look for when we are calculating and figuring out the cost of equity and applying it in the real world. A lot of you will have probably learned about cost of equity before, and a lot of the theory is very different to what it actually looks like when you're using the cost of equity for valuation. So the point of this workshop is to kind of give you an overview of that. Now there are a few points that do get complicated, and it's a basic overview, so I'm going to include kind of links throughout the presentation, which by the way will be in the chat at the end of this presentation, and I'll include links throughout so you can kind of look up the information that I've mentioned here and find out in more detail about what I've kind of talked about here. So the first thing that we kind of look at is the cost of equity equation, and obviously we start off with the risk-free rate when we talk about the cost of equity, and the risk-free rate will cover kind of the look of currency risks. So what kind of risks do I take on by investing in this equity in terms of the currency, and the things that play part in it is the expected inflation and the real interest rate. The other thing we look at is the beta, which kind of, first of all, we look at the premium, which is the equity risk premium or the market premium, has a lot of different names. Basically what it is, it's kind of looking at the risks that are associated with the company's kind of geography, so kind of macroeconomic uncertainty and kind of what are investors' attitudes to risks. It's kind of a market perspective. And then finally we look at the beta, which is related to kind of the company's business, and a lot of factors come into play with the beta. So the things are related to that, such as where the company kind of makes its money from, what kind of business mix it makes its money from, and kind of how is the company made up and how volatile is the market. So I'm going to start off with the risk-free rate first, which is the easiest to understand. And the risk-free rate can be defined in two ways. It can be real or nominal. Real means that you don't include the inflation, and nominal means you include the inflation. Now we usually do nominal, but if you want to do real, then you kind of, what you're doing is getting rid of the inflation. Now what's important to remember here is if you're going to do real risk-free rate, then you're going to have to turn all the details in your valuation into real terms as well. So for example, if I'm calculating or forecasting the future growth rate for the revenues for this company, I'm going to have to do that in real terms. So I'd have to actually predict what the inflation will be in those future years and take that away from my growth rate so that it's in real terms. So you have to be consistent with what decisions you make. I always go with nominal with the risk-free rate. It just makes life easier. But there are certain emerging market companies that are actually easier to do in real terms because of the immense amount of inflation that's taking place in that country. So let's look at the risk-free rate. So first of all, the basic definition that you would have got in a lecture or somewhere where you've learned about risk-free rate is there's no default risk, okay? The idea of a risk-free rate is if I put my money into this security, there is no way that I'm not getting paid back, okay? Now, the truth is in the real world, such a security doesn't actually exist, okay? In the real world, there's always a slight chance that you might not get your money back, okay? If the world explodes, you're definitely not getting your money back, okay? So there's always a little bit of a chance that you might not get your money back. But there's securities are very close to being default free. There's a very high chance that you will get your money back, and it's very likely that it's a risk-free rate that we get from there. Now the other thing that you need to remember is, and you might not get mentioned this when you learn about risk-free rate, is there's no reinvestment risk, and this is really important. I've seen a lot of times where the wrong security is used for the risk-free rate because they didn't take into account the reinvestment risk, okay? So let's say I'm forecasting an equity for the next 10 years, okay? For those 10 years, I have to have a security that I'm certain that in that 10 years, I have a fixed percent of return that I'll get, okay? That return can't change. Now, if I invest in a 10-year security, so security that is forecasted, that is created to last 10 years, I'm 100% certain that that's the rate I'm going to get sorted. If I use anything less than that, let's say I use a 6-month security, so that a security that ends after 6 months, and I have to put my money in again into that security, so reinvest it, that's no good for me, because I don't actually know what the rate's going to be in the next 6 months or the 6 months after that. Okay, so the security has to be the length of the forecast that you're producing. So if it's 10 years, then it has to be 10 years, and if it's 5 years, then it has to be 5 years. It's very important. Otherwise, it just doesn't make sense. It doesn't work with the whole equation. And this, if you use the wrong one here, that can screw up your results completely. So as I've said here, yeah, the time horizon matters. Now, the other thing that you have to look at, as I mentioned before, is currency. You have to make sure that your risk-free rate is tied to security that's in the same currency as the valuation that you're producing in. Okay, so if I'm producing in dollars of, let's say, Apple, my risk-free rate security has to also be in dollars as well, because Apple's in dollars. So that's important. And why is it important? Because the risk-free rate will change depending on the currency, depending on the inflation for that currency. Okay, that's why you have to stick to the same currency. And finally, not all governments are risk-free. Okay, if I'm, let's say, invested in Argentina, the Argentinian government is not risk-free. In fact, they default quite often. It's quite a big problem there. And so if I'm going to invest in Argentina, I'd actually have to figure out some other way of finding the risk-free rate instead of just using the government-issued bonds there, because it's not risk-free. There is a high chance that actually they probably won't pay my money back. So before we move on and explain this further, let's say I am valuing a company in the US. Let's say I'm valuing Apple, for example. I'm valuing Apple over 5 years. So I forecasted Apple's income for the next 5 years. What do you think is the best security to use here for a risk-free rate? And you can put it in the chat if you want. Okay, so the answer is I would need to look at the time horizon. So I'm investing for 5 years, and so I'd have to look at a security that's 5 years, and there's a 5-year treasury in the US, and the 5-year treasury is secured by the government in the US, which is very likely to be paying back. So there is definitely a risk-free associated with that. So that's a really certain thing to make there. Now, the European 10-year yield is another question I have. I have 3 securities here. I have the UK issued government bond, France issued government bond, and a Germany issued government bond. Now I have a company that trades in Germany in euros. Sorry, no, actually, I have a company that trades in France in euros. So which security would be best out of these 3 to choose? And the best one out of these 3 would be the German Bund in this case. It can't be the UK, because the UK UK gilt would be in pounds, which is backed by the government. So I can't use that because it's a different currency. I can't use the French one because the French one is in euros, but the Germany is as well. And the German bond is actually got a lower rate. Okay. Now, if it's going to be risk-free, the one in the currency that has the lowest rate out of these ones is much more likely of the government bonds to be the risk-free rate. Okay, if it's higher, then there's a certain percentage of risk associated with it. So if it's higher, then it's not a risk-free rate. So if you can go lower. Okay, so basically after all this, the point is that we have 2 main factors that come into play with the risk-free rate. One of them is the expected inflation in the currency, so how much inflation am I expecting in the future, and how much interest rates am I expecting taking away the inflation. Okay, that's what kind of all the risk-free kind of government bonds are. They're basically a percentage bet, kind of showing me what I expect in the future for the inflation plus the interest rate to be. Okay, these are the two factors that should come into play when we're finding a risk-free rate. Now, there is more complicated questions here, which we're going to complete in terms of emerging markets. Okay, as I mentioned before, for example, with Argentina, there's not really a secure kind of government bond that we can use because they are very likely to default. Okay, so what I can do is I can figure out the default spread of the country, and what that is basically it's a percentage that is associated with the risk of the country. Okay, so I don't really want that to include that in my percentage. I just want the risk-free rate, but it's very hard to find the risk-free rate if I've got these risks on top of my risk-free rate. Okay, so one thing I can do is I can find a bond in that risky country that is in the same currency as in another country that has the risk-free rate, such as the US, and figure out the default spread. Okay, so in this case, I've got a emerging market government bond, and I've got the US Treasury rate, which are both in the same US dollar currency, and the difference between the two rates is telling me what the spread is. So what's the risk associated with that different country? Okay, so that's the difference. That's one way of figuring out the difference in the risk associated with it. The other thing I can do is the credit default swap. Credit default swap is basically just the percentage that's calculated to us by experts such as credit rating agencies, and it's basically just the percentage telling me what is the probability of default for that country. Okay, so that's another percent that I can use to figure out the risk-free rate. And finally, I can also use ratings, and this is kind of the last resort. You kind of use this when you don't have a CDS, a credit default swap, or a external kind of currency denominated bond such as the US. Then you can go for a sovereign rating. So for example, I don't know, if Argentina didn't have any bonds or anything that relates to other currencies, I would just look at the country's rating, again done by the credit rating agencies, look at other countries that have those ratings, and from that figure out what should my default swap be for this country. So you can kind of extrapolate the data from other countries to figure out what the default spread should be on this country, and then we can use this default spread in the equation. So let's say I have a Brazilian bond trading at government bond trading at 6.77%. Okay, and I figured out using the spread that the spread is 1.71%. Then I just minus that from the government bond, and then I get a risk-free rate. And I can do the same thing with the credit default swap. I use the credit default swap, minus that from the government bond rate to get the risk-free rate. And finally, using their credit rating of the country, using Moody's credit rating of Ba2, I can figure out using the average of other countries that also have a Ba2, the default spread, which is 2.51%, minus that from the government bond to get a risk-free rate of 4.26. And finally, this is probably the most complex method of finding the risk-free rate. There's this equation where you can use the risk-free rate of the US, for example, and then find the expected inflation of that country in their foreign currency. And using this equation, you can find out the risk-free rate. But you would use this in very niche conditions where it's a country where it's really hard to figure out the risk-free rate. The other methods are much more accurate, and this is kind of a last resort that I use. So to sum it up with the risk-free rate, the three things that are affected by the risk-free rate is the cost of debt. It comes into play with the cost of debt when you're calculating so we have the cost of equity, and then we use the cost of equity and cost of debt to figure out the cost of capital, or the weighted average cost of capital, and it does come into play in the cost of debt as well as here with the cost of equity. It also comes into play with the options valuation. So when you're valuing a common equity, you want to take away the value of the options in that company, and this risk-free rate will come into play when you're valuing an option, because the method there to value the option uses that. And finally, we have the terminal growth rate. A lot of the time, it's best to use the risk-free rate for the terminal growth rate, simply because it's the most accurate kind of representation of what we expect in the growth to be after the 10 years plus, if your model extrapolates that far. And it's a safe bet, because usually the risk-free rate is very close to the future a GDP growth rate. Now, obviously, you don't want your terminal growth rate to be higher than the country's growth rate, because that's just not possible. You know, how they can't grow, that the company just can't grow that fast physically. I've included a link here of a blog that I've wrote on the risk-free rate. So if there's something you didn't understand on this bit, you're more than welcome to read up on this from this blog and find out more about it. So then moving on to the company's geography, so the risk premium is the other part of the equation. So first of all, we're going to remember about using the past. So we can just figure out the market premium from the past. So how much basically the market premium is how much, in percentage terms, how much return do I expect by investing in a risky market. So we have the risk-free rate, and then on top of that, how much return do I want for investing into a risky market such as the equity market, okay? And we can use the history, so previous data, to figure out what kind of return I expect or want. But the problem with that is there's quite a lot of noise, and it has a big standard error, okay? And the other thing is there is bias involved. So, for example, the US has grown a lot, and it will be biased towards the US because of that, because it's matured now. So it doesn't really make sense to use the past when we're trying to predict the future with this equity risk premium. So instead, we use a different method, which involves finding a risk premium for the safest market globally, which is the US equity market, and then assessing each country's risk, so risk related to investing in each country, and then converting that kind of country risk into an equity risk premium. Okay, so let me explain what I mean by this. So starting with the mature market premium, as I mentioned, we're going to try and look at the safest equity market globally, which in this case we use the US at this moment in time, because that I expect the US equity market to have the lowest premium, because relative to more risky markets, okay? And if I use a method where I expect pricing to be a value estimator, so I can see from that, I can see the value of something. So if I stick a price on, let's say, Apple from the market, that's the value it should be worth, okay? And I can use that assumption to reverse the net present value formula with the cash flows discounted back to get the net present value. So what I do is I have the price on the left, I have the cash flows, and I need to figure out what my discount should be, okay? And I can calculate that using an IRR. So what I mean by this is, if you look at this equation here, I've got all the cash flows at the top, and I have the value of the asset right now, and I'm trying to figure out R, which is the discount factor, okay? So first of all, what I'm going to do is I'm going to choose a index that I can use for this. So in the US, the S&P is the best because it's the most representative of that equity market. And I can use the S&P value right now, the index's value, and I can also see the cash flows that are forecast for the next however many years. And I can use IRR to figure out the discount. Now, the discount here would be representative of the premium of investing in the US equity market, okay? So that's how I kind of calculate the equity market premium, okay? If you didn't follow along with this, it's pretty complicated, and what you need to understand is basically what this number is, and it's the percentage premium that I expect to invest in the safest equity market in the world, okay? That's the end of it. And then obviously, if you want to go into detail, just read up on these slides again, and you'll understand what it means. So now I've got my mature market premium, so I know kind of what the base premium is, and then I can add on top of that the risk associated with investing in different countries, okay? Now there's different ways of doing this. The first method assumes that my investment will be, or investment in this company is exposed to the country risk equally. So every single business in that country is equally exposed to the same amount of risk in that country, okay? So then I just add on the CRP into the equation. Or I can assume that the exposure to the country risk is similar to any other risk that the business is exposed to. Okay, so it's kind of spread out between each risk that the company is exposed to. Then I add it onto the mature market premium. So I have the country risk premium and the mature market premium. I just add them together to figure out the equity risk premium. Okay, so I have the base, I have the extra risk that's associated with the country. I just add them together. Okay, well, the third thing that I can do is I can find a weight. Okay, now this is the most accurate way of doing it, because each business won't be, equally spread out across every single country. Okay, usually businesses will have different kind of weights across countries. So let's say Apple, they might get a lot of revenues from Europe, they might get a lot more revenues in the US, and maybe less revenues in Asia. Okay, and therefore I have to kind of weight each kind of risk related to these countries so that my equity risk premium is correct. So I can base this idea on two things. Okay, I can look at the location. So I can look at the start of the supply chain, and this is usually related to energy companies, so oil, gas, and that's because they're affected a lot by the start of the chain. So for example, I'm producing oil from Saudi Arabia. Okay, a lot of my revenues will depend on if I can get the oil out of the ground. It's not going to depend on is someone going to buy it, because people are going to buy the oil. It's, can I find oil in the ground, and am I going to keep finding oil in the ground? So I have to base my country risk premium on where I'm getting the oil from. Okay, so where I'm getting the product from that I'm selling. Okay, looking on the other side, and there's going to be companies that depend a lot on the operation-based country risk premium, which is where you're selling your stuff to. Okay, so Apple, as I said, they sell across the world. A lot of their revenues will depend on where they sell their products. Let's say in Europe, people decide that iPhones are not good for them, then their revenues will decline significantly because they're selling to Europe. Okay, so you have to look at the company when you're deciding which part you're looking at, their location or their operation base, to figure out which one to use to weight the country risk premium. So I'll just show you here in a practical kind of example. I would kind of put in the countries separately, or you can even do regions, and I'll figure out the revenues. Each country has a equity risk premium related to it, as I mentioned before, using those calculations, and then I would just put in a weight for them. So let's say this is 800. I would just put in a weight for each country depending on how much revenues I'm getting, to figure out the equity risk premium of the kind of business overall, depending on the countries. Okay. But again, as I said, that's the revenue side. But if I was looking at the location based, I would look at how much oil, for example, they're producing from, depending on the location. So that's the kind of risk associated with the macroeconomy, how people are investing in the country itself. And finally, we include a thing called the beta, which is related to the company's business. So that can depend on kind of what they produce, how much they're borrowing, how volatile is the market, kind of how the business is working, and what kind of sectors the business is working in. Now, to find the beta, I made two assumptions. One is that investors are diversified. Okay, they have a diversified portfolio. And the other thing is, so if I was going to invest, for example, in this company, I'm not just investing in this company, I'm investing in this company with a diversified portfolio. And I believe that price is based is a risk measure, as I mentioned before, with the calculation of the mature market premium. Price can be used to find value. Basically, it's a way of calculating risk. Okay, so price isn't just a random number. I can actually use that to figure out different types of risk. Now, the traditional way of finding out the beta, or how you have learned it, is the covariance over the variance. So the covariance between the market and the stock divided by the variance. That's how we usually get told how to calculate beta. The problem with this is, as I mentioned before, with historical data, it's a high standard error. There's a lot of noise in historical data. and you're basically focusing on just the time of the regression. So you're looking at the past business mix. So where the business has been selling. Has it been selling books and pencils, or staples and buckets, for example? Okay, what it's sold before, and not what it's actually selling now, what it's going to sell in the future. Okay, so this is kind of a backwards looking beta, not something that we could use in the future. And also it doesn't reflect the firm's financial leverage, which is basically how much of the firm is made up of debt and how much of it is equity. In the past, it might be a lot of debt because it's a new company, but in the future, it might be a lot more equity as the company becomes big and it doesn't need as much debt anymore. Okay, so that's why historical betas are not that great, and instead using a forward-looking beta is much more useful. Some of the factors that come into play in the unlevered part of the beta. So the unlevered part of the beta doesn't take into account yet the leverage, so the debt and equity. And the things that come into play there is the kind of nature and products that the company offers. So if it's a high growth product, then it's going to be a high beta. If it's a luxury good, which is elastic, again, high beta, because there's risk that people just won't buy that stuff. And if it's cyclical companies, so for example, it sells a lot some part of the year, but it sells much less later on in the year, again, that's also makes a high beta. There's a risk that then it won't make any money in the future. The other thing that affects it is the operational leverage. So kind of, is it a young company? If it's a smaller firm, they also usually have high betas. The kind of infrastructure of the firm, this is kind of the firm structure. These are kind of more fixed costs that can affect the beta. And once we lever the beta, what can affect the levered beta is the financial leverage. So how much of the company is made up of debt and how much is equity, and what we expect this to be in the future. So that can change a lot on what the beta looks like, depending on what it looks like in the future. So how do we do this? We start with a beta of the business as it is now. So you can actually use a historical beta here that you've been taught before, or you can figure out the unlevered beta using a business mix. So again, I've got a table here for a multi-business firm, and basically what I do is I stick in the different kind of segments of the firms, like computer, entertainment, blah blah blah, put in how much revenues they get from each, and then this will weigh out each business mix and give me a beta for each one, and then I kind of weighted average unlevered beta depending on the business mix. This is unlevered, so this doesn't take into account the debt and equity, so we have to re-lever it, and this equation here tells us how to re-lever the beta. This is just, you've probably come across this equation before. This equation basically takes into account the debt and equity ratio plus the tax rate, because debt is a tax shield, so it doesn't take the tax on the debt, but it has to take on the equity side, and we get a levered beta. Okay, now that's all good, but there's one assumption that you make when you learn this equation, and that is that the debt beta is 0. Okay, so the truth is you have the unlevered beta, that's the unlevered beta for equity. There's actually an unlevered beta for debt as well in the company. Now you assume that the debt beta is 0 because the volatility of bonds and fixed income instruments are very low relative to equity, and also the interest rate risk is much lower than to equity. And we also assume a going concern, which we basically say we expect the company to keep functioning in the time that we regress the cash flows in the future. But there is actually a slight risk involved with the debt beta because of the interest rate risk, and this comes into play much more important when you're looking at companies that are emerging market, because in fact emerging market firms emerging markets have got a lot more correlation between equity and debt markets, and so the debt beta might be very low for a AAA rated company, but for a company that's much lower rated, is much more likely to fail. You actually want to figure out the debt beta, because it adjusts your leverage beta much more. So if you look down there at the bottom, that's kind of how you adjust for the debt beta in the leveraging of the beta. Okay, I know it's very complicated, but at the end of the day, what I'm trying to say is you want to include the adjustment for the debt as well as the equity, because it does affect what your overall beta is for the firm. And to calculate the debt beta, there is actually an equation for that, just that there is for the cost of equity. So if I assume that it's the risk-free rate plus the beta, equity beta, plus the equity risk premium to find the cost of equity, for the cost of debt is the same thing except for the debt beta. If I reverse this equation, I can get a equation where it's the spread, so the equity risk premium over the equity risk premium, so the credit spread over the equity risk premium. That's how I can calculate the beta. Now, there is more information on this that I can share with you about the details of this, and it does come into play quite significantly when you're looking at emerging market companies. I've also included a link in the presentation that that you can use to kind of figure this out and understand how it works. But yeah, that's kind of the more realistic way of including the beta and making it forward looking into the future. Now, so that's how you kind of include the beta in there, and you can actually, depending on which country you're in, you can actually adjust these kind of mixes. Maybe I want to ERP equity risk premium just for the US, or I can make it for a certain region, and I can do the same with the business mix. I might just make it for the US, I can make it globally, or I can make it for certain regions. And this data is kind of available on finance tools. So I get this data, for example, from Thomson Reuters. So you can easily access this data and figure out what kind of the market looks like, and then from that you can derive it into your own cost of equity for your business. So I hope that was helpful, and if anyone has any questions, please just pop it in the chat. If you're watching a recording, then as you can see, my email is on the bottom right, so you can email me. I've also included the slides in this video, so you will be able to access the links that has been throughout the presentation, and I hope that this whole thing was useful. Okay, it looks like we don't have any questions here at the end. So with that, I'm going to end it. Thank you very much for watching, and we're going to be doing more workshops throughout this summer. And as we get back into uni, we'll be starting workshops, more workshops online. So please keep watching your email. Also stay in contact on Facebook and Instagram, where we'll update you on any new workshops that we will be doing. And please do subscribe to our YouTube channel as well. So thank you very much, and see you next time.